The heat on that trade is your fill would have been approximately 404 and 3/4. We'll just call it 405. Say you got slipped. Okay, something happened. You got in there. You didn't do it exactly right, but you're in at 19,405 even. The low of that candlestick. See, I just see what happens every single time I go to a candlestick. It jumps. All right, so the low of this candlestick right there comes in at 401.75. So that's 3.75 handles drawdown. So 3 times 20 is 60. Just call it less than like 70 bucks. 70 bucks heat. If you're trading with one mini, that's how much drawdown you absorbed before it turned around and started going in your favor. And it went just short of what price level? That's that upper quadrant level. That price is 401.25. What is the low of that candlestick? 401.25. There is no zones, okay? It's very specific prices. We're looking for very, very specific things in price. Because if there is an algorithm, for people that don't believe there is, then it would be repeating the same phenomenon and respecting very specific levels that we can predetermine as favorable or unfavorable, right? Did it leave the lower half of that gap open? Yes, it did. It didn't even touch the middle consequent encroachment level. So what does that mean? It's bullish. So that means you can trust that once it gets into this little new day opening gap up here, it's going to do what? It's going to accumulate. It's going to roll higher. Cleared the minor buy side I gave you. There. And now it's accumulating again. We're sitting inside of a pool of liquidity here after taking this Judas swing ride lower. Consequent encroachment, we've missed the 70% rule, hitting it in the first 30 minutes. It doesn't mean just throw it out the window. It just means that it's most likely 70% of the time after 9:30 opening bell, if there's a large gap, middle of that gap, whatever that width of the gap is from previous day's settlement to the first opening price at 9:30, half of that gap, 70% of the time, gets hit by 10 o'clock. Here we don't see it. Since I've been doing the mentorship and teach and taught it to you, we've seen 1 or 2 times where it hasn't done it, but eventually it gets hit. So you just got to relax and just submit to the idea that it's still on the table to be taken. Okay. Now, because we've spent this much time accumulating around the first presented fair value gap, look at the bodies. We wicked down through, but look at the bodies you're showing you. It's respecting it, right? So if we can manage to get above mid gap, I'd like to see it accelerate and move higher. Not just, I don't want to see it do this, like wick above it and come back down. I'm not interested in something like that. I would rather see it trade up above it and start building things like the fair value gap here, the gap in here. We went down and worked the lower half of this one, which I told you was going to fail. It wasn't going to provide a sell-off. And anybody else out there that thinks they understand imbalances and stuff, they may have looked at that and said, "Yeah, this is a short." It's not. Even though you were looking at probably all these wicks in here, and you call these dojis, Steve Nielsen's class of students would have been looking at that and saying, "Yeah, see, it's rejecting that." No, it's not. It's accumulating. It's accumulating. I'll show you in a second. Just relax. Let me get a drink. Let me go real quick over here so I can get rid of this diagram. The entries, my entry for a bullish fair value gap is I'm one tick one tick entering above number 3 candles low. And if I don't find a way to get in like that, like say I miss it or I'm doing something, my wife gets my attention, my dogs got out like this morning. I had to make sure my wife could get Scout in because she's a little unruly. She's like the brat. Something keeps me from getting in the trade at that very moment. I would rather have gotten into it if I was watching the chart. And say the market is now just below it. As soon as I see it like that, I'm in it like that. I'm not messing around with it. I'm just marketing it. I need to be in there because that's what I'm looking for. Now, that might sound like, oh, you're rushing to get money. No, I'm rushing to get in something I already would have been in. It's not like I'm chasing where it's going up already. It's offering me a better price that I was willing to pay for a buy but I just wasn't there to capture that buy. So now I have the wonderful opportunity of getting it at a deeper discount. So I'm going to go and rate at the market. If it can touch the upper quadrant, I'll buy that too. If it touches the consequent encroachment, I'll buy that too. Anything less than that, I'm going to do 1 or 2 contracts. That's all I'm going to do. Because I don't want to build it bigger. Because down here in the lower half, I don't want to see it spend a lot of time down there, if it does that at all. The ideal scenario is when price is up here and you expect it to drop down because you think it's going to go up into a longer, higher time frame target. Just use this example right here, because this is exactly what we're diagramming there in that little hand-drawn version of it. Take this off for a second so you can see. So this here is this. Trying to draw it doesn't snap to the magnet draws the little drawing things, makes them jump to it. There we